Hello again, everyone. It's 10 o'clock in the morning, Chicago time on Monday, January the 9th, 2023. Happy New Year to everyone. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe will be the most influential to U.S. stock market direction over the next several weeks and potentially through the end of the first quarter and into the second quarter of 2023. So let's begin and follow the money. Number 1, market internals. The Asbury 6 is negative. Those who have been following me either through Asbury Research or through my interviews on the internet like this one know that the Asbury 6 is one of our tactical models. The other one is the correction protection model, or the CPM. But this Asbury 6 is an indicator that I built so I could determine what the daily health of the stock market is and do it in a better way than trying to chase the S&P 500's tail, which the S&P, as we know, the daily volatility has really exploded over the past few years. We're up 50 today, we're down 100 tomorrow, and it's really easy to get sucked into putting on a position that you're going to regret. We chase these rallies and we get scared out on these daily sharp declines, and it makes it a lot harder to trade. So I took the favorite tactical tools throughout my career, started back testing them in different sets of 3, sets of 7, sets of 5, try to find out if there was a combination of these that would give me a clear daily check on the market's health. Just the way when the doctor sees you for your annual visit, he sits you up on the table and he does that short series of tests. He checks your blood pressure, your reflexes, he takes your pulse, he listens to your heart and lungs. This is what the Asbury 6 is meant to do for the market. And of these 6, which back tested in a way where if 1 or 2 of these metrics is giving an incorrect signal or is uncertain, the other 4 will pick it up. It keeps us on the right side of the market most of the time. 5 of the 6 on purpose do not have to do with the daily movement of the S&P 500. Stuff like breadth, volume, corporate bond spreads, relative performance between different assets that the daily gyrations of the S&P 500 really have no effect on. So right now, the Asbury 6 is negative. It's been negative since December the 15th. Why is it negative? 4 or more of these 6 metrics in one direction or another, red is negative and green is positive. So 4 or more have been red since the middle of December, negative. But you can see we also have 2 that are green. Why is that important? Is because if we go to 4 green, if we switch to 4 green, that is going to turn this metric bullish or positive as it did on March 1st of last year, as it did in the beginning of July of last year, as it did in the middle of October of last year. So if we get a flip to 4 green or 4 positive, that's going to start making me think more positively. What can I buy? Is this a bottom? Where is my risk? In other words, taking your defense off the field and putting your offense back on the field. It's not there yet, but again, all we need is another couple of green, and we're up 51 today. I'm looking up at our screens, and the S&P 500 is up 51. So the Asbury 6 is telling me that this is an inflection point, tactical inflection point. If the A6 turns back to green, that means that we are looking for opportunities to buy. Number 2, the S&P 500 testing critical overhead resistance. You're going to see how this is going to really dovetail really nicely with what we're seeing in the Asbury 6. So what we are focusing on right now today is this tactical resistance level here at 3904 to 3907. We have broken that. The S&P is at 3945 right now. We don't know how it's going to close. It could close lower. You know how the volatility is from day to day. But 3904 to 3907 is our important level. This is the S&P daily going back to July of last year. 3904 is the 3904 is the 50-day moving average here in blue. And 39.07 is the November 17th low. If we close through there, especially if the Asbury 6 turns back to green, that's going to tell us that we should get a quick move to at least 40.05 to 40.15. That's major resistance. That's the 200-day moving average, and it's also the trend line that we drew from the January 4th peak of last year. So it's a one-year trend line. So watch 39.04 to 39.07. If you have access to the Asbury 6, really watch this metric over the next few days. If we turn green and we break this resistance, there may be some opportunities for us to buy, and it would suggest that this low that we made at the end of December, December 22nd, could be a more sustainable low. Number 3, volatility. The VIX is at a tactical decision point. Here we have the S&P 500 going all the way back to January of last year. This is a daily chart. Down at the bottom, we have the VIX daily. Also going back to the beginning of January. And what we've shown here is that last year, during a major downtrend, whenever the VIX got to about 19, you could see on February 9th we did. That was a peak. On April 4th we did. That was another peak. August 15th, another peak. And December 2nd, we had another peak. The S&P, or the VIX, is right around 2021 in that area right now. If the VIX, if this is still a bear market, if we are still in a bear market, we are likely to see this rally fail today and the VIX move back up through 2210, which is its 21-day moving average. I'm pointing to it here. And that would suggest to us the downtrend is still intact and it's resuming here. However, if the VIX continues to hover around this 19 area, and actually if we are in the process of turning higher, we're likely to see the VIX move through 19 and move back down to that 16 or 15 area that we saw it sitting at for most of the 21 bull market. So really important to see what the VIX is doing. If the VIX starts elevating past the 21-day moving average, gets past 22, even more importantly, gets up above 24, it's going to indicate the market is getting fearful again, and we're likely to see another decline. So we're watching the VIX so far here. We're watching the resistance level here at 39.07 in the S&P 500, and we're watching like a hawk the Asbury 6 to let us know what the internal health of the market is going to be over the next several days. Number 4, investor sentiment, emerging strategic bottom. What we have here is the S&P 500 going back to 2018. This is daily, going back to 2018. Down at the bottom, we have a daily survey of futures trader sentiment. This is actually our own spin on the daily sentiment index from Jake Bernstein, who's kind of a revered futures market analyst, who's been around since I was a kid on the floor of the Chicago Mercantile Exchange. Here's what this shows. This shows that when these near to intermediate term oriented futures traders get to a least bullish extreme of 17% or less, as they did here, February 2018, Dec 2018, June 2019, and March of 2020, which was the COVID low, those were all what I would call strategic bottoms in the S&P 500. And so you can see now that we've been hovering at the 17 area really since the middle to latter part of last year. That suggests to me, unless we're going into some kind of a major bear market, which could last another year or so, I don't see that happening. I don't see that the market is that super weak right in here. So I'm looking at this low reading in this sentiment index as an indication that somewhere near this October 11 bottom, or maybe the June bottom that we made before that, or maybe the Dec bottom that we just made a couple of weeks ago, somewhere in here is going to be a strategic bottom that's going to be the springboard for the next bull market that could last 1 to several quarters. This is not a timing tool. This is an environmental indicator that tells me to watch these bottoms that we made throughout last year in June, October, and then in December, this bigger picture could turn into some kind of a major bottom that could be the starting point of a sustained move higher in the U.S. stock market. Number 5, market sectors. The SEAF model favors healthcare and financials. Again, those of you who are familiar with me from Asbury Research probably know about SEAF. The SEAF model is a sector rotation model. Last year, it outperformed the S&P by 12%, and it does that by following the money around the sector space. So you can see right now, financials, healthcare, and industrials are showing up in terms of 1, 2, and 3. We have a ranking system for this. If you want more information about this, instead of taking the time here, just visit asburyresearch.com and go to models, and there's a lot more about SEAF and also our CPM model, the correction protection model. But right now what this is telling us, our SEAF signals, our hard SEAF signals are in financials and healthcare right now, and also industrials. That's not a SEAF signal, but it's still within our ranking system. It is the third best and ranks between 1 and 15. It's kind of like golf. The lower the score, the better the ranking. So right now, financials and healthcare are our 2 SEAF model signals, and industrials is also showing some strength, which is why they're ranked so highly. Those are the ones that we are going to be watching in the weeks ahead to possibly capture some relative outperformance. So again, this is a really tricky level here, and a very important level. My feeling is that the next significant move in the S&P 500, either up or down, that's going to take us through the end of this quarter at least, is likely to start from this level that the S&P is currently testing around 3,900. So there you have it. If you like our approach to markets and investing, I invite you to visit our website at asburyresearch.com to get more information about us. If you'd like to see more videos like this one, there are more available on the Asbury Research channel on YouTube, and you could subscribe there. Thanks for watching, and we will see you at the next one.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.